Well, investors ended the quarter in a good mood. Stocks rose sharply, and once again, it was the financial sector that led the way, as it has on and off over the past 3 months. Now, yesterday, bank stocks sandbagged the market. Today, they lifted it on unconfirmed reports that Deutsche Bank has reached a deal with the U.S. Justice Department. More on that story in a moment. Meantime, the Dow Jones Industrial Average finished the session today up 164 points at 18,308. NASDAQ added 42 and the S&P 500 gained 17. And today's rally closed out an unusual third quarter, one that saw turbulence created by the Brexit vote early on, fresh record highs later, and continued uncertainty about interest rates. Of the three major indexes, the NASDAQ was the big winner for the July to September period, up nearly 10%, as you see there. But now we start the fourth quarter of 2016, and as Bob Pisani reports, it could start to get really interesting for investors.
If you're an average investor, you probably don't want volatility in the stock market. But professional traders like volatility because they make money trading price swings in stocks. Aside from some volatility earlier in the year as oil dropped and a little volatility when the UK voted to leave the European Union in June, there hasn't been much volatility this year. Traders hoping for big market moves this September around the Clinton-Trump debates or the Fed meeting were also disappointed. But hope never dies, and traders are pitting their hopes for market volatility in the fourth quarter on two events: the presidential election and the Fed meeting in December. It's not clear either will produce much market movement. The market seems to be positioned for a Clinton victory, with the House remaining Republican, a divided government. Should Trump win, that would certainly cause volatility, though many point out that a major source of that potential volatility is Trump's antipathy for Fed Chair Janet Yellen. Any disruption to the Fed, particularly if Yellen resigns, would cause a problem for the markets. And that brings me to the Fed meeting in December, where markets believe there's a roughly 60% chance the Fed will hike rates. The Fed is the big gorilla in the room. They are the only one of the long-term movers of volatility out there. Is there anything else? Well, there's a recession, but that's not on the horizon. And of course, you could have some kind of exogenous shock, like a terrorist incident. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.